Thank you very much. I'm so happy to be here, and the philosophy of TradingPub, it fits right in with my philosophy. There's nothing I like better than sharing what I've learned and what I've discovered, and I hope I'm going to be able to provide some insight today on some new things that maybe you can use right away in your trading. For those of you who don't know me, I've been a full-time trader for 11 years. I administer 6 advisories, and I've written a number of books. And the one that I'm going to focus on this afternoon relates to the patterns that are involved here in price surge system. It's a long and short trading strategy, and it is what I want to be able to share with you this afternoon. It's for getting in and out of trades relatively quickly, and in 3 or 4 days you're in a trade, out of a trade, based on a pattern that I'm going to be able to show you quickly this afternoon, and you'll be able to focus in on it on your own trades. But many of us come to the market by different paths, and Raleigh mentioned that I came via financial needs, and I think many of us do. That it could be that we have someone in the family that trades, or our education or profession has brought us there, but many of us need extra money for retirement. The weekly paycheck doesn't quite make it, and I did fall on hard times, and my husband and I lost everything. And so back almost 12 years ago now, I got into options, and every time I hit a roadblock, if there was something I didn't understand, I jumped in with both feet and really zeroed in, whether it was volatility or the Greeks or this or that, and plucked away at it until I kind of sorted it out and made it work for me. And some of the things that I discovered really fell into place, and I feel like I found my niche. But I found my niche as far as trading, but also having the ability to share that information, and that became my personal goal. Was not just my own financial independence, but to be able to help share the information and help others find financial security. And I've done that through books, writing newsletters that give lists of trade candidates that are creating the patterns that I teach, through coaching, and then through advisory services. The elements that I have found in my trading success are: 1, the leverage of option trading, buying weekly and front month options, and then really zeroing in on trades that are going to have explosive moves. And I'd like to cover this information kind of step by step and share with you how to find the trades that are going to have a 3 or 4 day average as far as being in the trade. Normally, a person would find an equity, maybe they're have a specific pattern, and then they zero in on the expiration date for the length of time that that particular trade is going to take to unfold. And that is how you put your trades through a normal trading funnel. And I'm going to show you how to turn it around, where you're putting the very specific trades in the narrow end and having it explode out the wide end. And of the 3 elements that I mentioned, leverage of option trading is the main one. And I would like to just real quickly go over some information so that you can see what that leverage is if you're not trading options. There's a lot of you that may be into stocks, maybe you're into Forex, futures. Options create an extra advantage, or I feel so. And so let's look at it. That Celgene is a company that most of us are aware of. let's say on September 29th, the stock price was $106.38, and by October 5th, it rose to $117.90. That's almost an $11.52 gain, or 11% gain. On the 29th of September, the October monthly expiration for the 106 strike premium cost was $4.15 per share. That would be $415 per contract, because each option contract is 100 shares, covers 100 shares. On October 5th, the premium when you want to sell is $11.30 per share, or $1,130. Now this is a gain of 172% for those 4 trading days. So we're pitting 11% gain in the price of the stock versus 172% gain for the price of the option. That had you, and most traders would not be able to do this, but had you taken the total investment for those 100 shares of stock at the price of $117.90, that would be $11,790. Most of us would not invest that much in one trade, but say you did, that you were able to spend only $415 for one option contract that covered those same 100 shares of stock, and it earned $1,130. So if you'd taken that $11,790 and applied that and bought option contracts, you would have been able to buy 28 option contracts for that same $11,000, and over those 4 days you would have earned $31,640. That is the leverage of options. You're able to get in with just almost like a deposit on a house. You're able to get in for a small amount of money, and yet you're able to multiply your gains. So this is Celgene's chart, and this is the entry here area for that trade, and then this is the exit. So here we had a nice fall in the price of the chart, and you would wonder, okay, how would I know when exactly to get in? And that is what I'm going to show you today, is the key, in a sense, to know when a price is going to go up. That you could have had several opportunities in here, and yet that didn't go up. It didn't go up here. What made this particular area difference? And that's what I'm going to show you. But let's cover the other elements that I mentioned first. So the second one was weekly options, and a lot of people are afraid of weekly options. They don't understand them. They've heard stories about them, and so for the last couple of years I've actually been on a campaign to tout the benefits of weekly options. And there's a number that I would like to go through here, and I'll do it very, very quickly, knowing that you all will have a recording of this and that you'll be able to read through it at a slower pace, because I want to get through all of the information. But weeklies are relatively new. They're celebrating about their 3rd birthday. They've been around longer than that, but as far as the general trader, it's been about that long. And we have been taught as traders about the value of time, and to make sure that we purchase extra time so our trades have plenty of time to unfold and play out. But this isn't the thinking behind trading weeklies. With weeklies, the aspect of time works in reverse. We're not in it looking for extra time to allow our trade to play out, but providing we have the trade direction right, we're seeking protection against the market's fickle change in direction, that we're using the short expiration to our advantage. So let's look at some of the advantages as we go along here. That weeklies are cost effective. They cost a small fraction of what monthly options cost. They're flexible. They're a useful trading tool for numerous strategies, just straight calls and puts and spread and covered trades. Long-term trades are subject to market changes. With short-term trades, you trade what the market hands out, whether it's what it hands out each day or each week, based on your particular strategy. And since weeklies are new every week, a trader can choose to enter at the moment that the action is really, really going to be happening. There's no need to tie up capital waiting for an equity that's going to go through a pullback or a consolidation period. You enjoy 52 expiration periods a year. They're available on the indexes, stocks, and ETFs. The exchanges offer new weeklies on companies every week, the ones that are becoming popular and traders have an interest in. And 1 week a month, all optionable equities become weeklies. I think I skipped 2 slides there. Let me go back. Weeklies are a short-term charter's dream that all you have to do is ask yourself, where will this equity be in a week or less? The shorter time frame allows for more accuracy. Weeklies can be used in conjunction with news reports and earnings and the FOMC meetings and minutes and so on. They remain more reasonably priced during periods of volatility. And once the news is released, they suffer less of a volatility crush than weeklies do because of the not having the time value. There's an advantage in the Greeks. Weeklies are inherently offer a greater delta. Weeklies don't suffer from high theta. Time value is less of an issue, as I said. Cheaper prices mean that you can purchase more contracts for the same total investment. Gamma is explosive with so little time value. And quick price moves before the market can change direction compounds the benefits and the leverage of option trading, like I showed you in the example for Celgene. And recently, the exchanges have been given permission to offer 5 weeks out in time. But you don't want to buy too far out, or you might just as well buy a monthly expiration. So my personal goal, as I mentioned earlier, was initially to achieve financial independence through option trading, but then to also be able to share that information. And I have found that doing this is by utilizing weekly options and my special patterns and strategies. And I'm going to reveal this to you, how I use my patterns to double money in a short period of time, and usually 4 days or less. And as always, there's a few losers, but most of the time, if you have stops in place, cut your losses short, the winners way outpace the losers. I hear from traders every day that are sharing their successes, and for many of them it really has been life-changing, that they are able to take the proceeds from option trading and apply it to their retirement accounts. They're able to incorporate it in there and increase their weekly paychecks and so on. I consider myself to be the average normal retail trader, that I have grown my investment account, but I still trade like the average trader. And so the trades that we're going to discuss and we're going to go over, I usually take about $600 per investment. And I figure that is an amount that normal traders are able to invest that have maybe have a $5,000 account or somewhere, say, under $10,000. That is a reasonable amount to put in a trade. And I see that as accomplishing the goals and objectives that I've set forth in the strategy. So we don't have just option leverage, but now we've quickly run over the weekly option leverage. So let's look at a trade here for Home Depot. I would like to also share the point that along the way I've discovered that what you want to zero in on is stocks that are going to move quickly. And so I've found that a 2.5% to 4% equity price move often equates to a double in a weekly option premium. And I'm going to show you several of these. I went through the slides before this presentation and found trades that just happened recently, so that I'm not talking about something that happened years ago. I'm talking about something that has just been in the last few weeks with the volatility that we've had, so that you can see how the price moves and how this my price surge system works. If we look at Home Depot, and let's say you purchase calls mid-morning on September 30th for $1.55 per share or $155 per contract. For the October 15th, that's just this past monthly expiration, which was about 2 weeks out in time, for the 115 strike call. And let's say you bought 4 contracts for a total investment of $620. So that fits into the $600 price range that I was talking about, total investment. And you sell at the end of the day on October 13th, 3 days before expiration. The call contracts were at that point worth $6.15 or $6,150 for your 4 contracts. That's not right. Is that right? That's not right. Yes, it is right. For your 100 contracts, for your 4, what am I saying? Per share for your 400 contracts. And so that is a gain of $5,530 or 892%. That's a crazy amount. And when you entered the trade, the price was approximately $112.50. When you sold, it was $121.50. So that's a $9 change in the stock's price. So that's a hefty 8% versus the 2.5% to 4% that I had mentioned earlier in the stock's price over those days. And yet the option increased 892%. So for those 10 days, you controlled $45,000 worth of shares of Home Depot stock. And you were able to do that with an investment of $620 for your 4 contracts. That's crazy. That's a crazy amount of leverage and increase in premium. And those are the types of trades that you can get into when you zero in on explosive moves. This was a big one of 8%. And have just an average size investment. This, again, is the kind of thing that can change lives. Let's look at the chart here. So this is the chart that we were just discussing. So you had this good size drop here, and what is going to show you that it's ready to explode? There isn't anything at this particular point on the chart that's going to give you that information. You can see that it's been actually trading in a range for a good while. That I am not an artist here, even though I really am an artist. But there's this tight range that it's been trading in, and it's actually dropped out of the range here. You want something that is really going to be able to show you that the stock is getting ready to move one direction or the other. So let's add an indicator. I love the price percentage oscillator, the PPO, and some people might not have access to the PPO. It is what I favor, but you can use the MACD, the MACD, moving average, convergence, divergence indicator. They're pretty much the same. It would be hard to tell too much difference, but I like the PPO. I like the formula that's used to come up with the indicator, and that is the one that I have focused on. For those of you who are not familiar with it, that as the black line here crosses over the red line, whether it's up or down, that signals the price move. So if we look right here, that it has crossed up, and we look up and price has moved up. Here we have a place that the PPO is crossed down, and we have the price moving down. Again, it moved up here, and we have this little move up, and then we have a cross down, and it's moved down right there. Moved down. So that reading the PPO chart is just, or indicator on the chart, is just that easy, that you can kind of follow excuse me, the direction of the crosses as far as the direction of future price movement. Let me take a swallow of water here. All right, let's add another indicator. This is the average directional index, the ADX, and I have placed it under the PPO, and one indicator has nothing to do with the other. The way the ADX is read is it is a strength or a momentum or an energy indicator. When it goes up, it is showing that there is strength in the move, but it isn't really telling you direction, that you could have a strong move up or a strong move down. It is just a matter of telling you how much energy is in the move. And when it is dropping like this, it is showing you that energy or strength is coming out of the move. It doesn't, again, necessarily mean that price is going to drop. It just has to do with the amount of strength in the move. So what I discovered along the way, let me see if I can get rid of got rid of the important ones, the lines here. What I discovered, and I feel like this happened maybe because I am an artist and I look at the market and charts differently than somebody that comes from a financial background, I discovered that when the lines of the ADX and the PPO come close together like this, I call it a squeeze. To me, the lines are coming in and they're going to hug. So that when the lines come in close together, they are squeezing in. And this is like a pressure cooker. It is a time when there ultimately will be this release of energy. And I'll show you on the next chart how that happens. And we'll go through a number of these real quick, and you'll find that you'll be able to recognize them very quickly. All right, here's Home Depot's move. So this is the design right here, the squeeze that I was showing you, where the lines come in together. And it is the lines then pushing away from each other that results in this upward move. And so when you see this squeeze take place and the lines then pressing away from each other, pushing away from each other, is a sign that this pressure is being released and that price is going to go up. So after just showing you one chart, I have no doubt you're going to be able to pick out and see other places. Look at right here. This is showing, again, Home Depot, but showing how the lines went further and further away from each other, and you see this end result of this really large move up from going down somewhere around 113 to 122. That is a huge move. Here's another example of a squeeze. This is Boeing. And again, you look here at the lines pushing away from each other once they've come in very close, and you have this large advance in price. Here I've marked two others. This is one where it just went up a little bit and then it re-squeezed, and it dropped and then created a super tight squeeze, and then as the lines pushed away from each other, you've had this really nice climb up. Went from 83, say, up to 90, a $7 move. All right, here's another one. This is Starbucks. And again, this is October 13th. We're not talking about something that happened a long time ago. The lines squeezed in very close together as they pushed away from each other. You have this climb up. All right, here's another one. You have a tight squeeze. The lines pushed away. This is Goldman Sachs. And we're covering lots of information here. You also have confirmations that I mentioned earlier that there was that one squeeze that re-squeezed. And if you didn't have your confirmations in place, you would not have entered that trade. All right, here's a brand new. I wanted to show you what one looked like before it started spreading apart. So when you see the lines coming in very close together like this, you begin putting your plan in place, and that is what is covered in the price surge system book. It goes through lots of examples like this, but it covers all of your confirmations in your chart setup. It covers what you will require as far as which options to select, which strikes to select, which ones are going to have the best advantage as far as playing out, and again, your confirmation in your chart setup. So here's Visa's chart. That was the one we looked at, and you have this spread apart and this big price burst. Went from 68-ish up to 73. So this is, we're going to cover the figures on this, but again, this is, if you'll remember that you want the 2.5 to say 4% price move, which will double your option premium. So had you purchased calls mid-morning after the open for $1.23 per share, or $1.23 for the contract, you purchased the October week 2, that's the second week expiration. You selected the 69 strike call. And let's say you bought 5 contracts for a total of $615. You sell on October 9th, which is expiration day. The contracts were then worth $4.70 per share. That's $2,350 total, or a gain of $1,735, and that is a 282% gain. So when you entered Visa, the price was $68.50, and when you sold, it was $74. So that was a $5.50 change in price. Again, that was about 8% move, and what you had was a 282% move in the option over that same period. So this again shows the leverage of options. It shows you the extra leverage of weekly options, and the pattern that we're covering shows you how to zero in on stocks that are getting ready to have that explosive move. So all you have to do is get the direction right. And select your options and proceed. I want to point out that it doesn't take just a particular company. You want to zero in on the ones that are having big moves, but here's one of the, this is the Russell ETF. You have a squeeze right here. Any type of equity, and truthfully, any type of trading. I mentioned earlier that some of you may trade Forex or the futures or whatever. This pattern will show up on anything that can be charted. So it's not something that is just specific to option trading and charting something for options, that if you were to be trading stocks, you can locate this pattern in the confirmations and benefit from a stock gain. Also want to show that it is available in any time frame. Now, there are traders that want longer term trades and they trade dailies, and some trade 60-minute charts. This is a 15-minute chart, and you have this same pattern with the lines coming in. You have them spreading apart, and you have this nice climb up. Here's a 5-minute chart. Look again. This actually shows two. Here's one that's a little wider, has a little more space, but you have a nice climb up. Here's a very tight one, and you have this this climb. Now, this comes on a point that I have people ask all the time. They say, Wendy, you know, when the lines get really tight like this, almost touching, does that mean that the move is going to be larger than a move where the lines have more space between them? And it really doesn't. It really is based on what else is happening in the market and the support of the market direction as a whole. But anytime they come close together like this and the lines are spreading, you're going to have a move up. That's just, it's the way that it works. So when you see a chart that's forming like this and the lines have come together, you put your plan into action. And again, all of the details are covered in the Price Surge System book. It covers both long and short, and we're going to briefly look at some short trades and the pattern and how that works out. That the books are written in a very easy to read. I kind of write the way that I talk. I just figure I'm just down home, everyday person. It doesn't read like a financial textbook, but it covers everything you need to know. There isn't anything that's left out. Now, I wanted to point out, because we discussed that earlier, I showed you a trade or a pattern that didn't go. I call these re-squeezes. And in this trade, you would not have entered here. You would not have entered here, and you wouldn't have entered there, because you wouldn't have had the confirmation signals. And it would have kept you out of these trades so that you wouldn't have entered here and then run out of time because you bought a weekly option. You would just not have entered, because you would have had all your ducks in a row and known that even though you had the pattern and you have this little push away and you have even a little one here, that the other elements were not in place, and you would not have entered this trade and waited for the, if you want to say, official squeeze. Here's another example where you had the lines come in very close 4 times, and yet the overall direction, even though it went up this little bit, and you have a little bit here that has taken place, it wasn't really enough probably to have been a super positive trade, that you would not have had the indicators to show you that it was the right time. So here we have Joy. It had a $2 move here on this particular squeeze that spread apart, and this one was a $4 move as it moved in. On that the $4 move, this is what it would look like if you'd entered on August 8th and had purchased the August 50 strike calls with 8 days until expiration. The ask premium was 69 cents per share, or $69 per contract. You purchased 10 contracts. Again, that stays within that $600 range that I was saying for a total investment. We stretched it a little by $90. And you sell on August 13th for a bid premium of $2.58 per share, or $258 per contract. Or for the 10 contracts that you purchased, it was $2,580. That was a profit of $1.89 per share, or $18.90 for the 10 contracts. And so that was a 274% gain in 4 days for a 4% move in Joy's price. This is what changes people's lives and your financial situation, is the leverage that you can zero in on by getting the direction right. So here we have my rendition of the reverse funnel, and the squeeze pattern that we've been looking at here, and that no doubt you can pick up when you look at charts tomorrow if you were to set them up, is called a P3 squeeze pattern. So the short pattern is called a P3.5 pattern. That this, again, is the normal way the funnel would work. You'd zero in on an equity, you'd zero in on a pattern, you'd decide on your expiration date, and your gain would come out the bottom part of the funnel. We're taking weekly and front month options. We're taking stocks that have large moves. We're using the P3.5 exit entry patterns, and that shoots profits out the wide end of the funnel. That is your leverage that you're having. The books and the details and covers everything on the P3 pattern and the P3.5 pattern. There are stages that those patterns go through. One is as it gets started, it tells you what your stop is. It tells you and gives you actually even a second entry if you miss getting in as it first gets started. It tells you when you can relax and take a breath, and then it gives you your exit. And all of this information is covered within the Price Surge System book. So the beginning point is zeroing in and learning how to find just a few stocks that are going to have these big moves. And let me show you, hopefully the next chart or so will show you. Here is the P3.5 pattern. This is a short squeeze. So we have the squeeze forming here, and the explosive move on this one happens as the lines spread apart, and there's this big drop that takes place. I think there's a couple of them here. I know I'm probably running long, and I apologize. Here again is the short squeeze. This is showing us that we're going to have a big drop. It hesitated here for a minute, and then as the lines push apart, you have your big drop down. So the Price Surge System is a book. It's 145 plus pages. It also comes with a DVD that details the long and the short patterns. It goes through all of the stages that I just mentioned that help you to know when to get in, a second entry, stop, when you can just take a deep breath and watch things unfold, and you don't have to be watching it quite as close, and then your exit. And it covers the same information on the P3.5 pattern. So the idea for narrowing in and having your explosive gains come out the wide end of the funnel is the fact that you can ride an equity up, you can ride it down, you can ride it back up again, because you've learned how to focus in on the fast-moving companies that are going to have big moves. And then you have your long pattern and your short pattern, and you can have it just flow from one cycle to the next, because you have these patterns in place, you have the confirmations, and you can just have a small group of stocks that you become an expert on, and you get used to how they perform and they play out, and you watch the patterns and can just go from your calls to your puts. So what makes the price surge system different or better? You have the book that I mentioned, you have the DVDs. Then there is a weekly newsletter that comes out on Monday and Wednesday. And it lists stocks that are creating the patterns. So it's not like you have to look through thousands of charts looking for these particular patterns, because they're given to you on Monday and Wednesday in the newsletter. And you just follow what's going to happen. You apply the symbols to your chart template, wait for the confirmation signals, select the options and the expiration and the strike based on the guidelines that the book covers, and you're in and out of trades on a regular basis, whether you're going long or whether you're going short. So we've covered all of the basics. You have the leverage of options, you have the additional leverage of weekly options, and then you are zeroing in on trades that are going to have big moves. For information, you can go to my website, wendykirkland.net. You can email my support. You can call. And for those of you who are attending tonight, we actually have a special offer. And I don't think you'll actually be able to click on this link to activate it, but maybe Yana can post it in the chat box. There you go. Thank you. Oh, well, good. Good. That's perfect. I appreciate it so much. Well, we have covered the basics of the two patterns, and I have no doubt that you all will be able to put the PPO and the ADX on your charts and be able to find that squeeze pattern just based on this quick review that we had tonight. And I appreciate so much being invited, and it was my pleasure to be able to share the information. I hope it helps.
Well, Wendy, thank you so much for your time, and I hope that you have just a few more minutes to answer some questions that's come up. We've got Wendy for another 5 or 10 minutes or so, so now would be just a great time to send in questions that you have.
I'm seeing one question. I was going to say, I see one that typed in the chat about what platform has PPO, and I use stock charts a lot, but there's others out there, Thinkorswim, and I think I mentioned this at the very beginning, that if you don't have the PPO, you can use the MACD, the MACD, and it works equally as well in creating that squeeze pattern.
And I know that there were a number of questions from traders, Wendy, about your entry and your exit points, and I think those are things that are probably pretty well covered in your book, but because your focus was on, hey folks, these are patterns, and then there are confirmation signals, and those things come together, and then you lay your plan. And I think your point is that these things are really pretty well covered in the book. Is that correct?
Exactly. They are covered in detail in the book. There's lots of examples, and you're right that once you apply the confirmations to the pattern, it just creates a clear picture. And if it then doesn't work out, it tells you exactly what your stop would be. And again, I have looked at so many of these squeeze patterns that they truly do perform in a strategic way, that if they fail and they re-squeeze, and then they go through the stages. And I actually did a DVD once that was called The Life Cycle of a Squeeze, and that really is the way that they work. It's almost as if they're conceived, and then they have their birth, then they go through what I call almost like a toddler stage, where sometimes there's a few false steps and they fall down, and then they get back up, and then you have the adult stage where they're mature, they proceed in a normal kind of sturdy, steady fashion, and then they expire and roll over, and that is your exit. And it goes very clearly through these stages. And again, that is all pointed out in the book, step by step.
All right. And also, Wendy, I was taking a look at your special offer because I want to make sure that people are aware of what you've put together. If I understand things correctly, there's the 145-page price surge system book, and then there's the weekly newsletter advisory that comes out every Monday or Wednesday. And if I understand the special correctly, that's all for $197 a quarter. Is that correct?
That is exactly right. And in addition to that, there is a DVD. So for some people, they can read through something and they're taking in the information, but sometimes it helps to have, just like today through the webinar here, it helps to have somebody talk through it. And that's what the DVD does. Again, it's just backup information of examples.
All right, that's terrific. And I think the other thing that the question that came out, and I'm going to make sure that I understood it correctly as well, is that, as I'm sure you know, there are thousands and thousands and thousands of stocks and optional stocks that you need to sort through. But I think you do a lot of the work for us, because if I understand correctly, your weekly advisory is really going to zero in on those stocks or options where there is a pattern presenting itself, and it saves your clients the time to have to sort through all that. Is that correct, Wendy?
That is exactly right. That on Monday afternoon about 4 o'clock, and then again on Wednesday, I send out a newsletter. Well, it's actually, I send you an email that tells you my website has been updated, but on the website, so it's there for you to access anytime during the week, is a list of stocks that are creating both the P3 and the P3.5 pattern, so that if the overall market is kind of supporting a downward move, you would probably focus in on the P3.5 and again, the P3 long. And those stocks are listed so that you are applying them to your template that you've set up, and as soon as you get the confirmation signals, then you know exactly which options to buy, and you follow the trade, either to a point where it has a nice gain, or if it were to turn against you, you know exactly where your stops are to get out, and you cut your losses short and move on to the next one.
Oh, that's terrific. And once again, folks, all this is covered in the book, and on the recommendations that Wendy's going to provide are suggestions around entries and exits. So I think that's great. And I think the last question that came up, and I was interested in the way you covered this as well, Wendy, there are several folks that are saying, hey, can I use these patterns to trade other markets, commodities like crude oil or Forex or whatnot? And if I understood you correctly, I think you said as long as you put the PPO and the ADX indicators on your charts, regardless of the market or even the time frame, these patterns tend to hold true.
Exactly. It doesn't really matter. It can be a commodity, like you said. It can be gold. It can be crude oil. I have friends that use it for Forex. That's not my thing, but they have great success using it. It can be applied to anything that is chartable. And again, with the charts I showed you, it'll work in any time frame. So you, I'm sure, have some day traders. You probably have some that are more like a swing trader, and others that want to get into something and they don't have the time to look at it every day or maybe even every week, that you can apply these same patterns to a weekly chart, and by leaps, that the patterns work in any time frame.
All right. Well, folks, I want to thank Wendy for that terrific presentation on how she uses weekly options and the PPO ADX squeeze pattern to find stock options that are getting ready for these big explosive moves. I personally liked how simple and highly visual the squeeze pattern is, and that it can be used to trade, as we just talked about, almost any market or time frame, although all of Wendy's experience is on options. I also want to thank Wendy for warning that the squeeze pattern by itself does not generate a signal. There's a confirmation signal that needs to come along with that as well, and that's what helps you determine when's the right place to make an entry. And all this is covered in the book and the DVD and the material that are provided. I also want to thank her for that limited time special offer that she's extending to the TradingPub members for that 145-page price surge system book. It has a DVD that comes along with it and a very valuable weekly newsletter advisory that comes out every Monday and Wednesday to help you make decisions about weekly stock option positions you might want to take during the week. And this is $197 a quarter. That's not per month. That's $197 per quarter, so a little bit less than $70 a month for all of that. So once again, Wendy, thank you so much for the time that you took to prepare and to share your presentation with us today. And I'd like to thank all of you for coming and helping to make this a very successful webinar. So on behalf of all of us at the Trading Pub, we would like to wish you all a pleasant rest of your day, and we look forward to seeing you at our next event. Take care and be safe. Bye-bye.